I'm Gwen Preston of Resource Maven. We're here at the Metals Investor Forum in Vancouver in January, and I am joined by Shane Williams of West Red Lake Gold Mines. It's a long name for a company, my friend. Thanks for being here.
It's great to be here.
So let's dive in. West Red Lake has two assets, a gold deposit that is beside the gold mine that you bought last year. This is not an operating mine. This is a mine that a company called Pure Gold built to much market excitement, got up to because it was a new high-grade underground Red Lake gold mine. And that's the stuff of Canadian gold dreams, right? People love that. Then there were reasons that mine failed. It operated for about 18 months and then it went bankrupt. So let's start with the elephant, which is, why did it fail?
So, look, a lot of our investors, everyone I speak to talks about that.
Of course,
because it was the most loved and the most hated asset in Canada.
In short order.
in very quick, short order. So, as we went down, we saw a lot of things. At a high level, we believe, look, their motivation was not to build a mine and operate a mine.
Yeah.
They were a group who promotionally wanted to build a promotion effectively. That's what we believe. Unfortunately, they never set the mine up for success. There was a lot of companies around talking to them. Mm-hmm. At the time, Great Bear was running very hot. Mm-hmm. Evolution Gold Cup were talking about that mine. So there was a lot of M&A activity around here. And they went in with the idea, I believe, that they were going to get going, show the market they were in production,
right,
and hopefully somebody would come in and take them over. Because the way they set up the mine, unfortunately, was they leased a lot of stuff, they pushed back capital, they didn't put in the right people in the mine, and I think the market cap got well ahead of them. They went to $1.2 billion, which even in a good market is a high valuation. And they were talking to groups, we know that, and then people just walked away with the valuation. And then I think they were left, we're going to have to build this and run it. So, and they did well, but the debt really killed them. They took on a lot of debt. And as a junior miner and a developer, debt is tough because it puts covenants on you. It forces you to move at a quick pace. You need to meet covenants, which in this case was a covenant they needed to be in production by a certain date. And that drove everything. It drove their ability to get money and drove their decisions, how they leased everything. They didn't want to show extra capital. So that really drove them there. And then they had a lot of challenge of getting people. And they started to get people and inefficiency of the right people and different people. They went through like 6 GMs there in a year and a half. They went through COOs. They went through a lot of people. And look, in the end, then COVID. They were just there, and then COVID slammed them there. So that was a bit of an unfortunate thing. Yeah. Look, COVID affected every mine in the world, but particularly on a startup. You're looking for spare parts. You're trying to get people. You're trying to ramp up. That's not easy. Yeah. So those kind of pronged approaches, I think, were the ones that drove them over. But what we saw they were just nearly there. They brought in some very, very good people near the end, guys that I know, good underground guys working in good mines today. They just began to turn around, and they were just so frustrated. They got in, they just saw the turnaround, and then in the end, they just ran out of time. And that's what we saw. They were nearly there. That's a good opportunity for us.
Absolutely. I mean, what you need in a mine, in any mine, is margin. And the way that you get margin is usually through grade and low costs. And if you're going to push a bunch of your costs into operating, then you're screwing your cost advantage. And then there's also a grade issue where a big chunk of the reserve at Madsen, the name of the mine, is very high grade, but in the name of getting to production faster and these decisions, they actually started mining a lower grade part. So they disabled the two ways that they might have been able to get margin. They disabled themselves right off the bat.
Well, and these systems in Red Lake, as you know, they're deep systems. They're high grade, down deep, but it costs money to get down deep. It takes time, money, drilling. And they got into an area called the McVeigh Zone. And McVeigh Zone was easy to get at. It's near the mill, no development. They drilled it from surface. They had an understanding of it, which at the time was probably their good understanding, and they went for that because it could show the world they were in production quickly. Unfortunately, they had a lot of inefficiency, but they also had dilution. They had a lot of bad mining practices, and the grade was lower. And all those together with trying to start up, and then COVID hit you, it's a tough slog for sure.
Now, the opportunity obviously for West Red Lake is that none of the things that we've just discussed need to be permanent. Right? None of the problems that they faced are natural characteristics of the deposit, their approaches to how it was mined. So that's really the premise of why your team, backed by Frank Justra, decided to come at this asset.
Yeah, I mean, look, Frank has a long history here, and Frank likes to buy stuff that's unloved.
Yes,
You know what I mean?
yes.
Unloved, the opportunity is there, and this asset was definitely unloved. So when it came up, we got a team, we went down there, and that's really stood out for me that a lot of ore bodies are challenged or they're very difficult, but they never saw that. They never got that opportunity.
Yeah.
So people put together the bad ore body and the company and the bad management, and it was all lumped together as one big, we hate this asset.
Yes.
But it wasn't actually, the asset never got an idea to perform.
Yeah.
So we saw that, they made a lot of bad decisions, they made a lot of management decisions, they had a lot of issues, but they never really got into the heart of the system, where the value is, where the grade is, where it is. So that's what we saw very quickly. And in the last 6 months, they just turned, they got into the core of the ore body, and we could see production was getting there.
Yeah.
Grade was coming up, recovery was coming up. There was another 6 months, I believe, and $20 million, they would be true.
Yeah.
And we saw that I came back and I said, wow, this is something we got to do.
Okay, so then lay out for me in brief sort of West Red Lake's now approach over the next year to ensure that when you do restart this mine, which is the intent at a little bit down the road, to ensure that it's gonna be the mine that it has the potential to be.
Yeah. So as I said, the geology in the ore body is the main issue, was the main issue with this. Everything else is there, permits, mill, everything. So what they did then was they really we need to take time and understand the ore body. So we're going underground. We're spending a lot of money, a lot of time drilling underground, very tightly spaced drilling, and really understanding that ore body.
Yeah.
And that's going to take some time. It's going to take some effort, but we believe it's de-risking the ore body. And a lot of people will want to see before we even, look, this mine could start up tomorrow.
If you wanted
to,
yeah.
this mine could start up tomorrow. But I don't think the market would, oh God, here we go again.
Yeah.
So we're going to step back. We're going to de-risk the ore body. We're going to have it a very, very tightly spaced drill. We're going to do 50,000 meters of underground drilling.
Yeah.
We're going to do new studies. We're going to do a reserve. And I want to have a year and a half of mineable inventory designed in stopes, ready to go before we even think about starting up. And the board will want it the same. So that's what's going to take the time.
Yeah.
And that level of money and time and effort, I believe, will turn us around and turn the story. And there is the exploration potential. There's a couple of good zones. We've seen the 8 zone is one we've talked about before, where these are the equivalent of the high-grade zone in Red Lake, potentially. And so that's something that, in parallel with this de-risking strategy, we intend to explore.
So, I mean, that's a good way that's a good last topic, is this parallel to the high-grade zone or the rebirth of the Red Lake gold mine, right? And this is how we got the major Canadian gold mining companies that we have, right? And this is a mine that was okay, it was doing fine. Then new group came in, new vision on exploration and how to approach things, discovered this high-grade zone. Bam, this became a gold mine for the history books. And as part of your reserve drilling, you're also doing a bunch of underground development. That's going to enable you to do better exploration, access more areas, and see if this asset, which, like you say, that 8 zone, it's down there, it's deep, but man, it's got an 18 gram per ton.
Yeah, and it's very interesting because when you put an analog to the high-grade zone in Red Lake, it's at the same depth, it's in the same type of rock, which is different to the rock of the main body. It's in the ultramafics. It has the same strike length. They call the Red Lake zone the pencil zone. It's shaped exactly like that. So it has the potential. And also we're in this Lassonde curve. We're in the boring phase, as you know.
Yeah.
But a discovery drilling on this high-grade zone is like the front end of it. So we have the de-risking going and the exploration growth. So I think this year is going to be a very exciting story for West Red Lake.
Absolutely. Not to mention that your Lassonde curve should be a lot shorter than the boring phase lasts for most, because you got a lot of the work already done.
Yeah.
Cool. Well, I mean, I love the story. I love keeping up with it, and good luck with all of the avenues that you're pushing this year. And it'll be exciting to catch up again. I mean, over the year, but it's certainly in a year, and see how you can present the story at that point.
I think it'll be a different company at that stage.
Absolutely.